The stock market was down last week due to concerns over rising treasury yields, which increased fears of higher borrowing costs and their impact on economic growth. Additionally, mixed economic data and cautious sentiment around the Federal Reserve's future interest rate policies weighs on investor confidence. As we can see, right now we are sitting in between fear and extreme fear. And when we take a look at some companies just last week, notably Palantir, down double digits, which isn't something we have seen in quite a while for a company that has performed very strongly. Now, over the last 5 days, down nearly 13%, and a few reasons that we will discuss in terms of why this company is down. Now, the first one is due to Morgan Stanley. They did initiate a coverage with an underweight rating. They expressed concerns that Palantir's valuation is higher than justified by their performance, and the analyst acknowledged the company's strong execution, but does believe the market has already priced this in. We also have some profit taking by institutions. Cathie Wood's ARK Investments selling around 200,000 shares. Now, this did coincide with the stock's decline, but actions like this by large investors can overall influence market sentiment and contribute to the stock price volatility. And for those that do like a bit of technical analysis, the stock did break down from a rising wedge pattern, which does indicate potential for further decline. Now, for those that want to see some of the support levels, we can in fact note the key support levels to watch out for are around $66, which is sitting around the price now, $59 as well as $45 if this decline does continue. And we can also see broader tech sector weakness. Technology sector in particular has faced some of the largest declines, so you could argue some of that broadness has also impacted Palantir's stock performance. But if we look at some of the larger analysts, for example Forbes, they believe that Palantir's stock slide isn't over just yet. And if we move on to Morningstar, well, they actually have some very bad news if you are a shareholder, or maybe good news if you see it as an opportunity to buy the dip. They believe the fair value estimate of this company is at $21, and they believe in terms of value right now, it is a 1 out of 5, very poor. The economic moat narrow, and uncertainty around this company very, very high. Now, in terms of just quickly looking at the company, yes, over the last few days hasn't been great. Over the last year, though, it was one of the, if not the best performer in the S&P, up 300%. And whilst it does still trade at the upper end of the 52-week range, we do see a pullback from all-time highs at $85, with every single analyst giving this a hold. Although Quant 3.49, not far off the 3.5 to flip this into a buy. And we're also going to discuss shortly the very high forward P. So is this a chance to buy the dip on a high quality company that has performed very well? Or in fact, are we going to see a lot more weakness, and should we perhaps either consider selling or just holding? Other things that we want to incorporate into our analysis is insider ownership, which sits at around 13%. We see around $2.5 billion worth of sales over the last year. Now, if we look at the most recent quarter, that is Q1 of 2025, we see the selling has started at 36 million. Now, we will show you this for transparency, but do bear in mind, not something we use in our own analysis, as insider selling can be done for many reasons, personal or financial. We in fact noticed 3 sales in 2025 so far, the largest one by an insider of just under 500,000 shares, netting them $36 million. And as you can see, information is there if you want to incorporate it yourself. We do the same aspect, but on the institutions, 46%, 1.6 billion worth of sales over the last year, a lot more buying at 5.3 billion, again in the same time frame. But we do need to point out, in the latest quarter of data, Q4, closing out 2024, institutions sold more than 10 times than they did buy. Now, do bear in mind, they did buy more over the last year, so this could just be due to the end of year selling, but also always do your own due diligence, never copy what investors or what insiders do. Now, for those that don't know, Palantir does develop data analytics software for organizations to integrate, manage, and analyze large data sets. Their flagship products, Palantir Gotham as well as Palantir Foundry, are used by government agencies, military organizations, and private enterprises for tasks like intelligence, logistics, and decision making, and the company specializes in artificial intelligence, machine learning, and advanced data visualization to solve complex problems. Also, Palantir's software is widely recognized for its application in national security, healthcare, as well as finance. We also want to bear in mind this is a company that has been performing very strongly. In terms of net income, it has been moving in the right direction that we do want to see over the more recent quarters. The same to be said for their operating income, and when we take a look at their revenue growth from the same quarter last year, it is up around 30%, and the main reason we see this, in fact, if you just look over the last few weeks, they have been announcing a lot more deals. In their latest quarter of earnings, 36 of the 104 deals they closed were worth 5 million, and 16 of these were worth at least 10 million, something we do anticipate to continue to happen in 2025. The question is the valuation right now a little bit too pricey? So in terms of moving forward, over the next 4 quarters, they do expect growth to the EPS at double digits, which is a great sign to see. And over the last 4 quarters, they have at a minimum been in line with 2 marginal beats, so 100% track record. And if we look to the earnings per share of 2025 at 48 cents, this means their forward P right now is 141, which, without kidding ourselves, is incredibly high, and just at a first glance does look incredibly overflated, and possibly you could argue, like we have seen with Morningstar and Forbes, this is one that is going to continue to come down, but no one has a crystal ball. In terms of the underlying metrics, while the free cash flow over the long term has been moving in the right direction, granted it was negative, nice to see it flip positive and consistently. Over the next 12 months, expected around 45 cents, which is always great to see. With these numbers, we want consistency over the longer term. Sales growth, double digit every single year, but you could argue that for a forward P in the triple digits, maybe you would want to see not only more growth, but actually consistently at maybe triple digits. 25% though noted on a trailing 12 month, and we can see the growth over the last few years from 600 million in 2018 to 2.65 on a trailing 12 month. Now, we'd also like to point out that shares outstanding we typically highlight give us companies that do share buybacks, return excess cash to investor pockets. Whilst they haven't done that, they've actually diluted your position over the long term. This isn't something you would perhaps worry about if they can continue to outperform the S&P, but also bear in mind they are doing a lot of insider selling if that is something that you want to incorporate in your own investment thesis. ROIC, one of our favorite metrics, 10% or more, give us faith management are able to effectively allocate their capital. Not something we have seen in terms of consistency, but nice to note it has been moving in the right direction, and 8% on a trailing 12 month, and given the movement does make us believe over the longer term this will be moving in the right direction and we will get consistency. Same to be said with the operating margin, nice to note 14% on a trailing 12 month. Ideally, we do want to see this at 16 or above, and we also like the fact of the efficiencies moving in the right direction, upwards and onwards. In terms of the free cash flow margin, above 5%, which is the minimum over the last 3 years, nice to see a strong 40% on a trailing 12 month, and as we will show you when we run through the balance sheet, it does look very strong with the 0 from 2020. What this tells us over the last 4 years and over the next 12 months, it won't even take Palantir 1 day to pay off all of their debt net of cash on hand. Now, we also want to let you know we have released our latest free weekly article where we drop one every single Monday morning to your inbox covering severely undervalued stocks as well as what's gone in the market over the last few days. So click below, you can sign up, read straight away, where you'll be able to gain access to 46 undervalued stocks for the month of January. Lots of information for each one, the upside that Wall Street themselves see over the next year. And on top of that, you can grab a recently released copy of 43 stocks that Wall Street themselves believe right now have the most upside in the S&P 500. So click below, you can sign up and start reading straight away. Now, we've already shown you their top line revenue, which did look very strong. We can see pretty consistent over the longer term at double digit growth, and based on the trailing 12 month, 2024 is expected to close out as another strong year, but we ideally want to show you what does the bottom line story tell us. And in fact, 2023, so the last full year, was their first year of profitability, and we can and are pleased to say that based on the trailing 12 month, December 2024 is expected to continue with some nice growth, 210 million with 477 on the trailing 12 month. Then we want to show you the balance sheet, which, as we said, did look very strong. So we do a quick health check, total cash versus total debt. Cash has been increasing, sitting right now at 4.6 billion on the latest quarterly report. And when we do compare it to their total debt, which is what we do because one number in isolation doesn't tell us anything, we can in fact see it was sitting 0 in 2018. Now it is sitting at 255 million, which is very small in comparison to their total cash, which tells us it won't even take them one day to pay off all of their debt, as we mentioned earlier. We also want to flag here the cash this company does generate from their operations. Whilst it has been negative for a few years, from 2021 it has been positive, and we can see based on the trailing 12 month, and whilst we didn't show it in terms of their investor presentation, they see their free cash flow for 2024 to sit at $1 billion. So in terms of gradings, first one is valuation, which is no surprises, they do get an F. When you do look at it in comparison to the sector median, this just tells you right now, if you have been buying this company, you are paying a 613% premium. Now look, this is reinforced no matter what valuation metric you use, and you can argue it does deserve a premium. It is a high quality company. Question is, how much of a premium should we be willing to pay? And that is what we will get to when we look at our own valuation. In terms of growth, they get an A, year on year up 25%, better than the sector at 5, forward looking 22, better than the sector at 5.5, and the EPS over the next 3 to 5 years anticipated to be 28%, which is a lot better than the sector comparative at 15.3. We then move on to the profitability, where they do get an A, gross margin 81%, better than the sector at 51, bottom line 18%, better than the sector at 3.8, and the cash they generate from operations just under $1 billion, significantly better than the sector comparative at 98 million. And when we just take a quick snapshot, a triple hold from Seeking Alpha, Wall Street and Quant, F on valuation, A on growth with an A on profitability. And two more things before we do jump into the valuation. Firstly, comparing their performance over the last few years against others in the application software space, we can in fact see Palantir up 300%, and actually they're not the best performing. We actually have a few others that have performed significantly better, and over the last 3 years we notice again fairly similar performance, the second best. Just something to highlight here, but do remember past performance is not reflective of the future, and the same analysis against the S&P, which has massively underperformed Palantir. And when we do look over the last 3 years, the same to be said. Always something we like to compare just to consider in case you do believe the S&P will outperform, and therefore maybe consider a low-cost ETF to track it. Now our intrinsic value today at just under $60 is derived from the DCF model, where we do always look at it in terms of the free cash flow year on year. The average growth rate very skewed as it has been negative a few years, and we do have the $1 billion that they do anticipate for the full year of 2024 as our starting point. With a growth rate of 35% and a discount rate of 8, we get the present value of future free cash flows and terminal value. Add together with the cash, subtract total debt, get to the equity value, divide by the shares outstanding, and as you can see here, our intrinsic value at $59, which does actually indicate downside of 10%. Now remember, these numbers are subjective. You can grab a copy of this model by clicking on the pinned comment below, running through your own numbers, whether it's for Palantir or any others, but full transparency for those that believe 30% to be correct, $45 indicating downside of 32%, and for those that are very bullish at the 40%, $77 upside of 17. Now we will take the medium rate as we typically do on this channel, and what we always do, because we aren't finished there yet, is apply a margin of safety. Now 10%, use that, execute on that if it meets our 3 golden criteria: wide moat, strong financial metrics, and good forward-looking data. If you believe that in today's episode, a buy at $53, which tells us right now you are paying around a 10% premium. Some people will be happily enough pay a premium for a company, but don't also forget this intrinsic value is based on them growing their future free cash flows at 35%, something that some people may believe to be achievable, others may disagree. For those that do want to note, at 10%, a buy at $53, at 15 around 50, at 20 around 47, and at 25 around 44. And we can see right now Wall Street themselves, with the hold rating as we showed you earlier, have a price forecast of $47, which indicates right now downside over the next year of 29%. Now, for those that believe in the long-term game with Palantir, they do see this at a $1 trillion market cap company. This will be essentially trading around $431 if we don't get any stock splits. Now bear in mind it could achieve 1 trillion, but this is something that is far away. We're not talking about the next year or two, but always good just to see, especially for those long-term holders. Now if we think about the pros of investing in Palantir, they do have strong growth potential. They've positioned themselves as a leader in AI and big data analytics with expanding contracts in government and commercial sectors. They also have recurring revenue, long-term government contracts, and growing enterprise adoption, providing a stable and predictable revenue base, and also AI-focused innovation. Their advancements in AI and machine learning do give them an edge in emerging technology trends, but we do also need to consider some of the cons right now. Their high valuation, although despite their recent declines, they could in fact still be overvalued relative to their current revenue, their profitabilities, and we did see them have an F on that valuation metric. They do have a significant portion of revenue coming from government clients, exposing the company to policy risks and budget cuts, and also the company has a history of operating losses and the path to consistent profitability does remain uncertain. Having said all of that, do give us your thoughts in the comments below. Is Palantir a company you are looking to add? Maybe you've sold, or in fact you are just holding, or for whatever reason doesn't fit your overall thesis. Do let us know. Don't forget to sign up to the free weekly newsletter. We are dropping the next copy Monday morning, and grab those spreadsheets and come and join us in the Patreon where we do cover our weekly buys and sells. As always, have a great one and we'll see you all on the next one.